Hey guys, Antoine Martel here, and today I'm going to walk you through my 4-unit apartment building that I own in St. Louis. I'm going to walk you guys through the cash flows. So I've owned this property for a couple of years. I bought it, renovated it, and now it's cash flowing every single month for me. And I'm going to break down the numbers for the deal and the cash flow every single month. I wanted to show you guys this so that you guys can use this same method to go to your own rental properties if you own any, and use the same formulas that I'm using to calculate your cash flow every single month. And to also give you guys an insider look at one of my properties that I own to see how much I'm making on the property every single month. So if you've never analyzed a deal before, especially a 4-unit apartment building, I'm here to break down the numbers on a 4-unit apartment building for you. So that if you're out there analyzing deals, you can copy this exact same model for 4 units or duplexes that you're out there analyzing every single day. And so this 4-unit apartment building was actually one of the first buildings that I ever bought. So I had bought a bunch of single family houses, a 4-unit hit my desk, I ran the numbers, I liked it, made the offer, got it under contract, and started the renovation. It was probably one of the first 10 properties that I ever invested in. And this property's in St. Louis. It's in an up and coming neighborhood. When we bought it, that area was kind of gentrifying. There was coffee shops, tea shops, yoga studios, all this kind of stuff. I really fell in love with the area. So much so that I actually went and visited the property a couple years ago. I stayed in an Airbnb right next to this property. So I'm gonna be showing you guys exactly how much money I'm making every single month from this rental property. Not gonna hold anything back. I'm gonna share you guys exactly the real numbers every single month for this 4-unit apartment building in St. Louis. But before we get into the video, please like and subscribe to my channel so I can keep helping you guys get out there, run numbers, analyze deals, and eventually make offers and get those properties under contract. I want to help you guys make cash flow every single month. So I ended up buying this apartment building in August of 2017, and I actually bought this apartment building for $159,000. So we're going to do that as the purchase price here of $159,000. And this is the most expensive property I had ever bought at this point. I was mostly doing single family houses for $30,000 to $40,000. So me going out at deal number 8, 9, 10 for me to buy an apartment building for $159,000 without knowing where I was going to get the money to fund this entire thing was pretty risky for me, but I decided to go through and do it anyways. And so in St. Louis, this is pretty average for a 4-unit apartment building if you're going to go out there and buy something. And remember, this property did need a lot of work done to the property, so there was a huge renovation budget, and the renovation budget here was $63,000. So the total all-in cost for this, if you take the purchase price plus the rehab, is $222,000. And when I was going to buy this property, I didn't know how I was going to fund it. I didn't know if I was going to get hard money or private money, but I'll tell you about how I did that in a moment. And for me at this point, having a renovation budget of $63,000 and doing a project for $222,000 all in, we're not even including the closing costs or financing costs yet, but that's a huge project for me. My normal average project was around $50,000, $60,000, so this is almost 4 projects all in one, which kind of made me feel a little bit better, honestly, because it is 4 units, and I was thinking, okay, instead of buying 4 single family houses, I'll just take a 4-unit apartment building, split it into 4. It's pretty much the same thing at the end of the day. It just has one roof, so that's what made me feel a little bit more comfortable with moving forward with this project. Now, obviously, this all-in number of $222,000 does not include closing costs and interest expense. Because what I was going to do is go buy this property, renovate it, rent it out, and then refinance the property and hold it for the long run. But the problem was I didn't have $222,000, right? So I didn't have the money to buy it, didn't have the money to renovate it, didn't have the money for closing costs, and to even pay the investor the interest expense. So let's say all in, we're $222,000 roughly, but then we have the interest expense and we have all the closing costs. So let's just say that this number is $250,000. So I'll put raise here. And I was going to raise $250,000. And the reason why is because it gave me a little bit of a buffer. Obviously, when you're doing this large of a renovation project, there's shit that can happen, right? So not only do I have the closing costs and the money to pay back the investor the interest, but I also have the risk of something going bad, and I didn't have much money in my bank account for stuff to go wrong. So I was like, okay, let's just over-raise. Let me raise $250,000 for this project. Now you may be asking, how am I gonna pay this investor back? And this was a private money lender. So normally I pay my private money lenders an interest rate of 12%. And that's an annualized ROI that those private money lenders are investing with me, and I'm paying them a 12% interest rate, which is 1% a month. So $250,000 at 12% annualized interest rate is $2,500 a month that I would have to pay this investor. So now I felt really good raising $250K. I have all these expenses in here, which are hard costs, and then you have the closing costs and $2,500 a month. Now I was thinking, okay, if it's $2,500 a month, how quickly can I buy the place? How quickly can I renovate it, rent it out, and refinance it? And I was thinking it was going to take about 6 months. So it's going to be about 6 months that I would have to hold this project to buy it, renovate it, rent it out, and then refinance it. So if you take 6 months times my monthly interest expense rate, that's $15,000 in total costs for the investor, for just the financing. So this investor that actually funded this deal was an investor that I met on Bigger Pockets. So while I was in college, I was out there networking, grinding, meeting people. I had already done a couple of deals in Memphis, and this was one of my first deals that I ever did in St. Louis. I made a quick little package. I told him the purchase price, the rehab, the all-in costs, the closing costs. I told him I wanted $250K to feel safe, to make sure I felt good about moving forward with the project. I'd pay him 12%, he'd make $2,500 a month for 6 months, and I was gonna pay him monthly, so I would keep some cash in the bank rolling to be able to pay for this monthly expense. So he would make a total of $15,000 at the end of the day. And you may be asking, is 12% normal? And so it's really normal for private money investors or private money lenders to be making anything from 8 to 12%. I was newer in the space. It was only my 8th deal that I had done in the real estate world. So charging 12% was pretty good. It was a pretty good rate that people felt comfortable lending me money. Now, obviously, now that I've done 500 deals, I can get that money way, way cheaper, around 8, 9, 10%. But when you're first starting, 12% is a pretty good rate. So once I had the investor lined up with $250,000, I felt comfortable moving towards the closing table, ended up buying the property for $159,000. Now, as soon as we closed, I got my property manager involved and the contractor involved, and they began doing the construction. And so construction works in paying in draws. So even though the rehab is $63,000, you only put like 20, 25% up front. They begin the work. And then after a month, they'll send you photos. The property manager goes out there, the contractor goes out there, they send you some photos back, you approve it, you send in the next amount of money. So it was only like in $15,000 increments along the way. Obviously, I also have to pay for these monthly expenses. So, you know, I was maybe burning $20,000, $30,000 a month. After about 2.5 months, the renovation was complete. And these were the photos we got back of the property once it was done renovating. And we used those professional photos to go out, put it on Zillow, Redfin, HotPads, Trulia, to get some tenants to move into the property. And so the rehab did go to plan. There was obviously some surprises. We did have to spend a little bit more money on the renovation. There were some surprises that came up along the way, but luckily I raised enough money to cover that buffer, to cover that surprise that did happen. In the end, it was only an extra $3,000 outside of this budget. So the total rehab, instead of being $63,000, was $66,000. It means the total all-in cost was now $225,000. So this is the new all-in, because this rehab was now $66,000. So it was $3,000 extra. For this large of a project is pretty damn good, but we did have to move and finagle some things around to still stay pretty close to budget. And so the best thing about this apartment building, the best thing about this 4-unit apartment building, was that it was a complete BRRRR. I was able to buy the place, renovate it, rent it out, and completely refinance the project, pay back my investor entirely, and keep the thing cash flowing for myself. So now once we got the property photos back, we put them up on the market for rent, and we try to go and get tenants to move into the property so we can begin the refinancing process. And so this 4-unit apartment building was kind of set up like this. So it was like a box, that's the roof. And so they had 2 upper units and 2 lower units. These lower units were a little bit nicer. They had a little bit more square footage. The building kind of got a little smaller as you went up to the upper floors. So these 2 units at the bottom rented out for $725, whereas the top units rented out for $695. So we got a little bit of a premium on the lower units. The upper units rented out for a little bit less, $695. We posted the properties online. We got some tenants over the next 30 days that were able to move in. We got the place fully leased out, and now it was time to begin the refinancing process. All right, so at this point, I had bought the property, renovated it for about 2 months, then leased out the property for another 30 days. So we were about 3 months into the project. But the problem with refinancing is that you have to own the property for 6 months before banks will allow you to do a refinance to pull out your money. And banks call this a seasoning period. Some banks have 3 months, some banks have 6 months. Some banks have 12 months, some banks have 24 months. It really, really depends. Luckily, the lender that I was working with only had a 6-month seasoning period, so that helped a ton. So the seasoning period begins when you close on the property. So banks want you to own the property, be on title for the property for a period of 6 months. They don't care about how long the tenants have been living there. As long as those tenants are on leases, they don't really care. So as long as you own that property for a period of 6 months or whatever the seasoning period is for the bank, you just have to be on title for 6 months. So at the 6-month mark, now that the property was fully cash flowing, making me money every single month, it was time to take this property, take this entire package to a bank and tell them I wanted to refinance the property. So now let's talk about refinancing. So obviously I had an investor that had lent me $250,000 on this project, and I wanted to refinance to be able to pay him back. So I kind of did the math counterclockwise, right? So I have this investor who I raised money from, and he lent me $250,000, right? And so I wanted to do a refinance and be able to pull this money out of the property so that I can pay him back his $250,000 that he lent to me. Because that means if I can pay him back his $250K, I own the property free and clear. I don't owe him a thing. And so when you do a refinance on anything from 2 to 4 units with a conventional lender, they're gonna give you a loan to value of 75%. And the way that you can do it backwards is you take this loan to value and you divide it by the amount of money that you want to get back in a loan. And if you do that, so if you take $250,000 divided by 75%, you'll get 333,333. Right? So this is the ARV, the after repair value that I wanted to take. Go to the bank, tell the bank, hey, I have this 4-unit apartment building. 4-unit apartment building, it's worth $333,333. I want to do a refinance. I want to pull my money out, and I want to get a 75% loan to value. So that's exactly what I did. I went to the bank. I told them the house was worth $335,000, and I tried to do a refinance on that property. The next part of the process is them sending out an appraiser out to the property to complete an appraisal. And luckily, the property ended up appraising for $330,000. And so this is the new appraisal, the appraised value of the property, which was $330,000. Which is fantastic. I wanted $333,000. The appraisal came back at $330,000, which is fantastic. And so if you've ever done a BRRRR deal before, if you've ever done a deal like this before, especially of this magnitude, it's not just a cheap little apartment building, you know how scary it is to send out an appraiser out to your property and hope that that property appraises. And especially for ARV, you know, the ARV and the actual appraised value to be this close for such a big project. I was super, super happy when the project came back and appraised at $330K, because I knew that I was gonna be very, very close to coming up with the amount of money I needed to pay back this investor so that I could own the property for free. So with that being said, let's do some math and figure out how much money I needed to come out of pocket to pay back my investor. So the appraisal is $330K. And like I said, banks will lend you this loan to value of 75%, which that means the loan that they were going to give me was going to be $247,500. So if you do a little bit of math there, you can see that I had to pay back $250K. The loan that I got, the check that I got for the bank was $247,500, which means the difference is $2,500. So that's the amount of money that I had to come up out of pocket in order to pay back my investor in full. Now, it's not that bad. To own a 4-unit apartment building for $2,500 is nothing. It was a lot of work. Luckily, this property appraised, you know, very, very close to what I needed it to appraise for. I only had to come out of pocket for $2,500. So now that this is done, now that the appraisal's done, the bank gave me the loan, now it's time to look at the cash flow. So now that this is all done, I paid back my investor, I now own the property. Let's take a look at the cash flow and how much money I'm making every single month for my $2,500 investment. All right, so now this is my favorite part of the entire process, which is talking about the cash flow. So we're gonna break down the cash flow, and first we always start off with the rents. And the total monthly rent with the 2 bottom units at $725, the 2 top units at $695, means the total monthly rent is $28.40. So that's $2,840 every single month in rent. That's gonna be your top line revenue every single month. So the rents are the only income that we're gonna be making from this 4-unit apartment building. Everything else is gonna be an expense. Now the first expense that I always like to talk about is property taxes. And I had to even go and double check and re-look at my property tax spreadsheet because I was extremely baffled by how low the property taxes were on this property. So the property taxes here on this property were $750 per year, which is crazy. It's one of the lowest property taxes that I have ever seen. And it's crazy that it was for a 4-unit apartment building. Sure, if it was a single family house for 50 grand or 60 grand in Memphis or St. Louis, sure, you could see 750. But for a property that just appraised for $300,000 to have property taxes of 750 is kind of ridiculous. And there's no real reason why the property taxes are this low or could be this low. It's really just based on luck, which is why in this entire video, I'm not gonna be sharing the property address so that St. Louis County can't give me a call. Remember, these property taxes are per year, so we're gonna be looking at the monthly cash flow. So let's remove the annual expense, and on a monthly basis, that is $62.50 every single month in property taxes, which is super affordable. The next item on the list for expenses is gonna be insurance. So this is property insurance. This is gonna take care of anything that happens to the property. If a tornado comes or anything crazy comes, knocks down the property, or if the tenants try to sue you. So I also include like a general liability insurance policy, which I would recommend you get as well. Now this insurance bill comes out to about $125 per month for an insurance on a 4-unit apartment building. Obviously, this is a little bit more expensive, but it is because there is 4 units and there is 4 families, 4 tenants living in the property. Now, normally when analyzing a single family house, you would kind of just take the rent, taxes, insurance, property management, debt service, and you'd be done. But a lot of people, when they analyze a 4-unit building or a duplex or triplex, forget about operating expenses. Because with single family houses, the tenants pay for lawn, water, sewer, garbage, all that kind of stuff. When you have a 4-unit building, it's a lot harder to split those things up. How are you gonna split up the lawn in 4 different pieces that everybody has to take care of? No. So that's why there's some things with 4-unit apartment buildings, duplexes, that the owner has to pay for and take care of. And it's my biggest mistake that I've seen a lot of investors go out there and make when they're running numbers for duplexes or fourplexes. They forget about these operating expenses that you, as the owner, have to take care of every single month. So the next item that I'm gonna put on this list is gonna be the lawn service. So you, as an owner, you'll have to take care of this lawn service. And normally you do lawn service, especially in Missouri, because it gets cold in the winter. You probably only need lawn service for about 6 months out of the year, and it costs per cut, and they do 1 cut a month, for example, $75 per cut, 1 cut a month for 6 cuts a year. So that means every single month, if you cut that up, because it's only 6 months out of the year and you need it for 12 months, let's just call it $37.50 per month for a lawn service. Now, the next item is gonna be water and sewer bills. And so water and sewer bills happen every single month. No matter what happens, you always need the sewer, and tenants will always need water. In some places, in some cities and counties, you can kind of split this up, especially with the water bill, where tenants can handle and pay their own water bill. That just wasn't the case here. It wasn't normal in St. Louis for the tenants to pay for the water bill. So in order to get the tenants in there, we had to cover the water bill. And normally for a 1-bedroom, 1-bath apartment in St. Louis, it costs about $50 a month per unit for water. And there's 4 units, so that's $200 a month for just the water service. Now sewer, on the other hand, is much cheaper. It should only be $50 a month for sewer for the entire building, which comes up to a whopping $250 a month for the water and sewer bills at this 4-unit building. And now another thing that I have here is I have a property management company managing this property for me, and they charge me 10% of the gross collected monthly rent as a fee every single month. So if they're collecting $2,840, I'm gonna have to pay them $284 a month, $284 a month for the property management service. And I think that this is worth its weight in gold. A lot of people ask me, I'm just gonna manage my own properties from all the way out of state and from 3 or 4 or 5 states over. It doesn't make sense to manage your own property. Trust me, property management companies are worth their weight in gold, and I'm gladly gonna pay them $284 every single month. And 10% is pretty average for the Midwest for the kind of rates you'll see for property management companies. 10% is what I pay for all of my markets. Of course, in some cities and some states, I have a lot of volume, so they've lowered that rate from 10% down to 8% or 9%, but 10% is relatively fair across the country. So now if we take all of these numbers And if we sum them all up, this is going to give us our net operating income. And so net operating income doesn't include the debt service. You'll see that I didn't include the debt service here. I obviously have a loan because I just got a loan for $247,500 to pay back my investor. The investor is now completely out of the deal. I own this deal 100% by myself for $2,500 that I had to write a check to my investor. So I own this building 100%. And if we sum up all these things, it comes up with the NOI, or net operating income. It includes all the income and expenses for the property besides the debt service. So the net operating income for this building, if you sum up all of these items, gives you a $2,081. So that means in 30 years, after I pay off the entire loan, I'll be making $2,081 from this apartment building if I pay off my loan. Right, so the loan that I got was 30-year term, 30-year amortizing loan. So that means if I make the next monthly payments for the next 30 years, I'll own the building completely free, completely debt-free. I'll own it 100%, and I'll be making $2,081 every single month, assuming the rents don't go up and assuming that St. Louis County doesn't increase my taxes. All right, so now in order to get the net cash flow every single month, we do need to include the debt service. So let's go back and talk about the loan. So I got a loan for $247,500, and I have an interest rate on this loan. The interest rate that I got was a 5% interest rate, and the term that I got was a 30-year term, 30-year amortization. This is obviously going to change your monthly payments, and I got a 30-year. I always get questions, Antoine, do you get a 15-year, 10-year to pay off the loan faster? Hell no, I always get a 30-year term. Please always get a 30-year term to increase your monthly cash flow. Trust me, it helps tremendously. It also makes your monthly payments much smaller, much more manageable. If a tenant leaves or is not paying rent that month, you can still cover it. You don't have to come out with money out of your pocket. So I always recommend getting the longer term. It's just a much safer option. So now if you take these numbers, because it's going to ask you for the loan amount, the interest, and the term, you plug those in, it's going to give you the monthly mortgage payment, $1,328. Every single month will be your mortgage payment. So now in order to figure out our net cash flow every single month, we got to take the NOI, minus it by the mortgage payment, which is the last expense on the profit and loss statement for this property. So if we take those two together, minus those two together, we'll get the net cash flow every single month for this property. We'll take $2,081 and minus it by the mortgage payment of $1,328 to get $753 a month. And people call this the NCF. The net cash flow every single month is $753. All right, so now we're all done, right? We're just making $753 a month and everything's good and everything's golden and there's no surprises that come up every single month. No, that's not the way that these go. That's not the way that things happen in real life. That's how things would go on paper. If everything went perfect every single month, yes, I would be making $753 every single month, but in reality, things don't work that way. So what investors normally budget for is maintenance and vacancy expenses. And so normally what investors budget for is 5% for vacancy, 5% for maintenance, and that's something that I do as well. So I will budget anywhere from 5% of my total monthly income, which is this rent amount. 5% of that number, I'll put it in a little piggy bank, and I'll call that vacancy expenses and maintenance expenses. So I actually don't take this money and go and burn it somewhere or put it in an actual different piggy bank, but it's just a way to run your numbers to make sure that your numbers are being realistic. Because obviously, like this loan that I got is a 30-year loan, right? I'm not gonna have a perfect month every single month for the next 30 years. Shit's gonna happen, maintenance expenses are gonna come up, tenants are gonna leave, there's gonna be tenant turnover, and that's gonna cost me. So anything that you budget, anything from 5 to 10% for vacancy and for maintenance is going to be quite realistic in the long run. And there's also something else that people budget for, which is called CapEx items. So these CapEx items, obviously, as you own the property for long periods of time, you're going to have these capital expenditures. So these are things like replacing the HVAC, replacing the hot water tank, replacing the roof. All of these things are going to be big, large CapEx items from $5,000 to $10,000 that may happen every 10, 20, or 30 years. Obviously, some things like a HVAC and a roof last for 30 years, so you may never have to deal with those kinds of things until you've completely paid off the property. But then you'll be making, $2,000 a month. Who cares at that point? But for this property, I'm not budgeting any kind of CapEx. And the reason why is because if you remember the slides before, I spent a lot of money on the renovation. And that did things like all the CapEx items were taken care of in the original renovation. So that's why here I feel comfortable with just budgeting 5% for vacancy, 5% for maintenance, and let's see what our net cash flow looks like after we budget those expenses. So first, let's start off with maintenance expense. So we're gonna take the maintenance expense of 5% of the total rent amount. The total rent amount is $284, which means that we're gonna have this maintenance reserve over here, and that number is gonna be $142 every single month. So again, I'm not taking this money and I'm not putting it in a separate bank account. I'm not holding it anywhere special. It's just a way to calculate the numbers to make sure we're being realistic and we're looking at a 30-year horizon. Now, there's another one, which is the vacancy expenses, and we're gonna do the same thing. So we're gonna take the rents, times it by 5%. You can go all the way up to 10% if you wanna be extra careful. I'm gonna do 5% because I know I'm gonna hold this thing for a very long period of time. So I'm gonna do 5% for vacancy. And that's gonna be the same number, which is $142 every single month. Now the last piece of this is gonna be CapEx, and because we did a huge renovation on this property, before we rented it out, all those CapEx items were taken care of. That's like the roof, the HVAC, the hot water tank, all those big items that come up every 10, 20, 30 years, were taken care of. So for this property, I feel safe for the CapEx, which a lot of people budget another 5 to 10% for the CapEx. I feel fine putting a 0 here. So now what we're gonna do is try to figure out the net cash flow after we hold back money every single month for maintenance and vacancy expenses. So we'll take the 753, we'll minus it by 142, minus it by another 142, minus it by 0 to give us our net cash flow after vacancy and maintenance. We'll make up a new term, and we'll call this $469 a month. So that is going to be my new net cash flow every single month, $469 versus the original $753. And so this is going to be a way that you can use to calculate a deal, including maintenance and vacancy, to make your numbers a little bit more realistic. So now that we know the net cash flow of the property on a perfect month and on an average month, we're going to take both of these numbers, look at how much money we have in the deal, look at our ROI and our return on equity, which is something very, very important that a lot of investors don't look at. All right, so the net cash flow that we have originally, net cash flow is $753, and that's before the vacancy and maintenance. And then we have the net cash flow after vacancy and maintenance. This one is $469, my favorite number. So now with these two numbers here, we're gonna calculate the ROI and the ROE. And so ROE, you may not know. ROI, you probably do. ROI is the return on investment. ROE is the return on equity, which is very important when you do a BRRRR deal, because a lot of people, when they do a BRRRR deal, they pull out all this equity, but they don't realize how much money they actually have sitting in the property at the end of the day. So we're gonna calculate both of those numbers right here. So first, let's start off with the ROI on both of these properties. Then we'll go into the ROE. And so the most important thing to note here is how much cash do you have in the property, especially for a ROI. So in this property, remember, we have $2,500. Pretty much nothing in this property, but that's what we're gonna use to calculate the ROI. And the ROI is gonna be the return on the investment. And my investment into this property is a $2,500. And so I'm gonna be making $753 here and $469 here. ROI, however, is annualized. So we're gonna take this 753, times it by 12, and then divide it by $2,500 a month. So when you take the 753 times 12, it's 9,036. You divide that by $2,500 a month, gives you the ROI, which is 361% return, which is absolutely bonkers, but it's because I only have $2,500 in the deal. Now to calculate the return on equity, it's a little bit different, because instead of the return on the investment, it's the return on the equity that we have left sitting in the property. And remember, the property appraised for $330,000. I got a 75% loan to value. So what you'll do is take the appraised value of $330,000, minus it by $247,500 to get the equity that we have in the property. And the equity that we have in the property, when you minus those two things, is $82,500 of equity that we have in the property. And the reason why I like calculating this return on equity is because so many people have so much equity sitting in these properties. And when they actually look at how much money they're making off of this equity, because I could sell the property and get a check for $82,500, a lot of people are not looking at the return that they're making on the equity sitting there. Because if this number is low, then I might as well just sell the property, take the cash, and go do something more beneficial with that money that I have sitting there, because it is real money. All right, so what we're gonna do here, very similar to ROI, except instead of 2,500, we'll use 82,500. So follow me here, 753 times 12, then take that number and divide it by the amount of equity we have in the property, which is 82,500. That's gonna leave us with 10.95% return on equity. So this is still a fantastic number. We're making close to 11% ROI for the amount of equity we have in the property, which is great. So now we're gonna move on to the net cash flow when you include vacancy and maintenance of 469. All right, so when you do the math for both of these, the ROI and the ROE, you copy the exact same formulas here, you'll get 225% here, and you'll get 6.8% for the ROE, because obviously the cash flow is a little bit lower. You have a ton of money sitting in the deal. So these are the two very important numbers that I would look at, because obviously these two numbers up here are ridiculous because we only put in $2,500 into the property. But 10.95, 6.7, 6.8, both very good return on equities for these properties. And it means that my equity is making me a good, significant return every single year. So I am pretty happy with the return on equity that I'm making on this property, obviously because my return on investment is ridiculous. And sure, could I sell this property, take the cash out, and then go invest it somewhere else and make maybe higher than an 11% return? Sure. But you also have to think I have to pay taxes, which is going to be, capital gains tax, long-term capital gains tax. I have to pay an agent. So this number is not really a true equity. It does cost some money to get this money out. So maybe instead of getting 82.5, I'd get 75 or 72,000, right? So we have to think about all these different things. For the money being in there, making me anything from a 7 to 11% return, I'm happy with that. That's a good return for the capital to be in there, making me money every single month. So sometimes we've done this analysis, the ROE versus the ROI, and the ROI will come back at like 10 to 20%, which is fantastic. But the ROE comes back at 3 to 5%. And that's exactly what happened with my larger apartment buildings over the last couple of years. We put so much money into the buildings, and they were worth so much more money than what we actually bought them for. So this equity we had was like $1.5–2 million, and the cash flow was pretty substantial as well. Which when you look at it on an ROE calculation, it was only making 3 to 5% return on equity, which is why I went ahead and sold those properties, took the cash, and I would rather put the cash into something like this. It makes way more sense than having an investment making 3 to 5%. So these are good, substantial returns. I'm gonna keep this building here, keep it going, keep it floating. But if this came back at 3 to 5%, I would probably think about selling the property, taking my equity, and doing something else with it. So after doing all this math and running through the calculations with you guys, I am pretty happy with this project. And look, I turned $2,500 into $82,500. And yeah, it took me 6 months of my life to do this deal, but I've owned it for a couple years now, since 2017. It's been making me good cash flow for the last few years, and I'm gonna continue to hold this property, keep on cash flowing the property. And remember, this is just one property. So I'm making anything from $500 to $750 a month from this one property. This is just one property in my entire portfolio. There's obviously larger ones. There's obviously much smaller properties that only make $100 to $200 a month. And I wanted to really share this property with you guys because I thought it was a unique deal, that it was like a really good BRRRR deal that I went from start to finish, and it was one of my earlier projects that I did back in 2017. So I hope that showing you guys this deal, walking you guys through the numbers was very helpful to you, so you can go out there, analyze deals, run numbers for deals, and you can kind of see behind the scenes of what I'm doing, the kinds of deals that I'm doing, show you guys how much money I have to raise, what I'm paying my investors, how much money you can make from a 4-unit apartment building every single month with everything included. And then most importantly, looking at your ROE. This is something that a real investor does when they have a significant portfolio. We run this calculation every single year on all of our assets to make sure that we're making a great return on these properties for the long run. It's not just about this ROI number here. This is much more important, because dead cash that's making you 2 to 3% on a house you bought 10 years ago is not worth it. You need to get rid of those old assets. And this is kind of like a spring cleaning for your portfolio, is running this ROE calculation. So now that you know the numbers of one of my deals, I want you guys to go out there and find your own deals, because you have everything you need to go out there and get started. Now, before you go, please make sure to like and subscribe to my channel. If you guys have any questions about anything I did here, please ask them down below in the comments. I'd love to answer them for you, and I'll see you on the next one.